Negative gearing means you're losing money. But don't forget the commercial outcome as well as the tax.
The lights are on, but no one's home because I don't know, no one's really asked me these questions, right?
It's a flip. The ATO is most likely going to look at that as a revenue transaction, not a capital transaction, so you don't get the 50% discount.
Buying in a particular entity, it may create unintended consequences.
Correct.
And you won't ever know that till you get to this part in your journey.
They could be on a fairly big salary already, or they could be making $1 million gain. Once you get beyond 190,000, you're paying 47% personal tax rate. You've got to be thinking, making these decisions ahead of time. You don't want to get a nasty surprise of a tax bill.
Success leaves clues. Again, we're saying knowledge is power. G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. I've heard a lot of listeners reach out going, I want to actually understand what's the best structure to buy. Do I buy my individual name? Do I buy through a company? Do I buy through a self-managed super fund? We're going to cover all that today. I've called him one of the big dogs in accounting, Peter Bembrick from HLB Manjud. G'day, mate. How you doing?
Hey, good, Aaron. Good, nice. Thanks. Good to see you,
mate. Great to have you here,
me.
Mate. I appreciate you making the time. I know you're a busy man. Mate, we were talking before, mate. You got an old son. Your son's finished high school. You're doing the round of formals at the moment, so you got your hands full there, I'm sure.
Absolutely, yeah. But you know, the light at the end of the tunnel there. Just got to wait for those uni results, ATAR results to see where it gets into uni.
Mate. There you go. Mate, I got my little ones entering school. You got your ones coming out of school.
Mate, a long way to go.
Yeah, correct. Mate, obviously with your tenure, 30 years in the accounting industry, mate, you've seen it all. You've probably seen a lot happen in, as much as you can probably have a lot of changes in tax. There's constantly always something going on in tax land. Our paths have crossed because I picked up, I told all our listeners, I'm constantly just reading and finding out information, for example. So when I saw your article, your feature in the AFR, I said, I want to have you here and having a chat in quite a small world. You actually know the team here at the studio.
Absolutely,
so
yes.
Make you feel right at home here. But with, I guess, your tenure, your experience and your knowledge, you'll cut across a number of different facets in tax and accounting. So we've got business structures, restructuring, international tax as well, family groups, capital gains tax, small business concessions as well, and then corporate tax, compliance and advice, mate. So you're spinning a few different plates in the air when it comes to tax.
But generally my focus is more on the sort of the SME sort of family groups end of town rather than the big corporate. So
nice.
I've got other partners who do that. So.
Yeah, great. So if you say, look, this is my bread and butter, what does a typical type of client or family group look like? What defines a family group?
Sure. Well, it varies, but obviously a classic client for me and for our firm would be someone like an SME business of a reasonable size, family owned. So they've got their business structure. And they've trying to build up a bit of wealth outside. And I know we'll talk a little bit about that as we go on about outside the business, because obviously so many people, they build their business. That's their life. That's their lifeblood. They put so much into their business, but at the end of the day, they have to have something to show for it. And so what we really like to see our clients do is building up some wealth outside the business, and that's where structuring comes in. And obviously, some of what we're going to talk about here is about that really.
Now, that's something I've covered a lot of turf on. And when people work, particularly business owners, and you probably see how many business owners haven't cracked that ceiling of potential, and they're working very, very hard, but unfortunately don't have the results to show for it. And what happens is they're not paying themselves consistently. They're not paying themselves what the market should be paying them. They're not putting money into super, which that's atrocious, but it happens. And then when they do go to their accountant, the accountant's giving them advice to say, let's minimize tax because, the ATO is the enemy, and therefore they can't go and borrow or buy property because the taxable income is too low to do anything. It's a tragedy.
Oh yeah, absolutely. Yeah, that's right. So
that's what I call sweat equity. So they got, so much hours that they're pumped in. They put a lot of their own cash or their borrowed money to go into a business.
Yeah.
And you see it.
Very risky. I mean, it's a very risky thing running a business. So
it is.
And as you say, they're often quite leveraged.
There's not a lot of profit to show for it. Whereas what happens is the businesses, they get to that tipping point where I now have proof of concept in the market. I've got a very good business in the sense that it's profitable. It's well run as an organization. And then off the back of that, now they're going, well, I could keep trading my time for more money in this business. However, I now want to build an asset base outside my core business. And they move into, say, commercial property. They move into shares. They move into buying their own home. There's different elements that come with then growing and scaling their own portfolio outside of their core trading business,
absolutely,
right?
Absolutely, yeah.
And so what type of businesses do you see that come across your desk? Like what the nature?
All range, from professional sort of service businesses, professional service businesses, someone like this, like storytellers running a business like dealing with people like yourself, but down to retail and like I really just the whole range really.
Yeah, lovely. Thanks very much. So, mate, we really want to touch on property. So, kind of if we dial it back into a property conversation as well, one of the big, and I want to start with this, is how the structure, because I think what happens here is people think the strategy is to buy property and the structure is an afterthought.
Yep.
You and I will both one of the first questions we'll ask is, well, what's your intention with this property? What are you looking to do?
Yep.
Well, I want to buy more property. Yeah, we all do. That's cool.
Why? What do you want to get out of it?
Correct. And then and you can almost see like the lights are on, but no one's home because I don't know, no one's really asked me these questions, right? And what I'm trying to say here, listeners, is it a buy and hold strategy? So is this a property that you want to buy and hold for the long term? Yeah, maybe you get into retirement, for example. Is this a buy and sell? So it's a get in and exit market strategy. Is this a buy and renovate? So you want to add some value. So it's an ugly duckling. You can add some value by strategically doing some renovations on it, get it revalued, and then put some equity in. So it's like the BRRRR method, which is buy, renovate, revalue, release equity, reinvest. Yeah.
Yep.
Or is it a buy and development? So is this?
That's right. There's all those different things.
Yeah.
And it's really a bit of a scale sometimes.
Correct. Correct. So when someone's coming to you and they're asking, hey, Peter, we want to buy property, and you're saying, look, why is the structure and the strategy so important?
Yeah, well, certainly, I guess to start out, obviously, my focus is very much on tax. So I've come up through accounting and tax, but definitely very much a lot of my time is spent on tax and thinking. So as you said before, accountants will say minimize tax, and definitely that is important, within the rules and
yeah, but it's like a broker beating the drum that low rates important.
That's right. So it's definitely not the be all and end all, but it's having a tax effective structure that meets your needs. Like just to I suppose just to think about negative gearing, which of course you would see all the time in your game. I always think that the one thing about negative gearing that it's amazing people don't really get is that they think it's a great tax break, but negative gearing means you're losing money. Doesn't it? So there's got to be a payoff. There's got to be that capital gain at the end. That yes, your costs are more than the rental yield on the property for a period of time, but at the end of the day there is capital growth. So you're going to make a capital gain, and so that's why you need benefit from negative gearing. So that keeps your tax down, yes, but you've got to you're still got to be making something at the end of all of this. So don't forget the commerciality, commercial outcome as well as the tax. I guess that's a key thing.
Yeah. So how would it differ? Let's put a scenario in front of you.
Sure.
So Peter, I've got my business. I run with my wife Bernadette, for example, and strong incomes. We're asset backed, and we're going to buy another investment property. But my goal is to come in. I want to buy a large site. It's got an existing dwelling. I want to knock it down. I want to put a duplex on it and then sell it, for example. Now, again, we're having a chat. You don't know my intimate
that's
details.
Right. I don't. That's
it's
right.
More
hypothetically,
general,
if you were doing that.
Hypothetical, general, not giving advice, people.
Absolutely.
But just this is a fireside chat.
Yeah.
What's some of the questions that would come up and how do we move forward?
Yeah. So I guess if you're putting that scenario to me, it's like, okay, so that's your intention. You're going to it's all about renovating it and selling it.
Yeah.
And so if it's not a buy and hold, it's a buy and sell. Then it comes down to a very, very fundamental tax concept: is this a capital type transaction, or is it a revenue or trading transaction? And it's just that's the the tax language that we use, and then the ATO will use when they're looking at these sorts of things. And so that's really important for a few reasons, but certainly you mentioned the structure. So if it's going to be a capital gains, just to get some really key concepts out there, like people would be aware of the CG's capital gains tax discount, 50% discount for individuals. So, and that's either individuals directly making a capital gain. So if they're the property owners, whether it's the person or the individual or the couple jointly, or if it's through something like a family trust or a unit trust, things like that, which we can get into more of the detail on that structures if you like as we go on. But just some sort of structure, then that's when it's again we're talking. And you mentioned that deal with a bit of cross-border stuff too. So let's keep this structure to Australian resident taxpayers.
Yes.
If you want to, we can touch on the cross-border at some stage if you want to, but
Yeah.
you have to always work it. You have to get some assumptions in there so you don't go too broad. So CGT discount is available to Australian residents directly or through things like a trust.
Yeah.
So if it's a long-term thing, then you would be looking at the CGT discount. But if it's the scenario you outlined, Aaron, which is buy and flip and sort of basically make a profit on it, no intention to rent at all, then the ATO is most likely going to look at that as this is a revenue transaction, not a capital transaction. So it's basically a taxable. It's not a capital gain. That's very important from a definition sort of perspective that you don't declare that in your tax return as a capital gain, so you don't get the 50% discount. So that's
okay. So that's no capital gains.
So that's a very important distinction.
Yeah.
And because when you talk about structures, like companies don't get the 50% CGT discount. So in fact, I've got clients who have quite a number of a client that I can think of who have a number of properties, and they've very clearly they know they define what the intention of a particular property purchase is, and they say these properties are capital. We've been reviewed by the ATO, and the ATO has given them the tick that said yes, they're capital. So being owned in individual names, they claim the CGT discount. If the ATO actually disagreed with their approach and said no, these are not capital, then they would have paid a lot more tax. So that review was a very big deal for them. So you've got to be making these decisions ahead of time, so that if you ever do get an ATO review, you're not going to get a nasty surprise of a tax bill. But in that case, they are going to do some property flips, and so they've said, okay, we're going to set up a company and we'll stick those flips in that company because we can make a gain and we can make a profit in a company. Maximum, the most you're going to pay in a company is 30%, and you get franking credits that you could pay out. If people know how franking works, we don't have to get probably into too much now. But the couple of things about a company: one, you can hold, and you referred to different pros and cons that you've looked at about that entity. So again, I'm covering a few different concepts here. So if tell me if I'm getting broad here, but this is if you can sort of put all these pieces together. Companies will not give you the CGT discount, but for something like a flip, it doesn't matter because you wouldn't have got it anyway. So the most you're going to pay is 30% in a company. You can also just keep the money in the company. So if you want to sort of have a vehicle that buys and sells properties, you can sort of play it all back in, take dividends when you want to. Whereas if you have something like a trust, or if it's just an individual or a couple owning a property jointly and they do a flip, the tax is payable when the sale happens. So there's no, and at marginal rates. So they could be on a fairly big salary already, or they could be making $1 million gain, and they'd be, once you get beyond 190,000, you're paying 47% personal tax rate. So that's a big, it's a flip. It's going to happen within a reasonably short period of time. So you're setting yourself up for a big tax bill, and hopefully you're making a big profit. And as you said before, it might be worth, if you're going to build up some wealth, some capital to grow your wealth, then make a good profit and pay some tax, and that's fine. If you're happy if you know what you're going to be up for. But if it is a flip and you want to, and particularly if the idea is to start to build up your wealth and keep it in an entity, then that's where a company for that sort of activity may be appropriate. So,
what about GST?
GST. Well, that's obviously with property, that's a big topic, and that's there's so many ins and outs in GST. I suppose one of the key things is if you're, in fact, that the GST legislation uses the concept of a capital asset as well. So again, this concept of revenue capital there's so many tax cases on revenue capital. It's such a fundamental concept that so if something's revenue, and this is where unlike income tax, residential versus commercial is there's all these categories of if it's new residential, it attracts GST. If it's old residential, it doesn't. Sort of, as I'm sure you're well aware of this because you deal with property quite a lot. Correct. Or commercial, industrial sort of property is going to attract GST as well. So there's this. If you're going to be doing those sorts of transactions, if it's a revenue flipping sort of situation, then the entity, whether it's the individual or the trust or the company or whatever, will need to be registered for GST most likely if turnover is more than 75,000, which in these sort of property transactions that almost certainly will be.
Absolutely.
So whereas if it's a one-off capital transaction, you may not necessarily need to register for GST. So there's sort of things that's one thing to consider. And then you got into GST margin scheme, which I'm sure you're aware of, and it's whether you want to go there or not. But that's just, I'll throw that term in there anyway. And even if you don't want to get right into the detail of it, because that could almost be a topic in a discussion in itself. But that's
I think what happened, and just to jump in, I think what happens is we just this rolls off your tongue, right? I've obviously had to, when I've cut my teeth in growing our own portfolio, for example. The first few times I heard this, even from our own, personal accountant, it would just go over my head. And I'm like, you got to write this down. I don't know what's going on. And I think that's generally what happens for a lot of people. And as a listener, I've got massive amounts of empathy as well, because I've been in your shoes. What you don't know is what you don't know.
Correct.
But the whole point of this type of episode, and the whole point of having someone like yourself come in here, is never about spruiking your wares.
It's not at all. It's about educating people.
The education part. And
telling them what questions they need to ask.
Thank you. Correct. Spot on. And it's, okay, if we can just open this conversation before you have a chat to before you're buying the property, having a chat to your conversation, or having a chat to your broker, because what we're going to cover off is buying in a particular entity. It may create unintended consequences,
Correct.
And you won't ever know that till you get to this part in your journey when you go to sell. And you and I are probably similar, where built my business, built it to this certain level. Cracked the level, and then it's like, I didn't realize we had to pay payroll tax now. It's like,
and all sorts of things. And probably the thing and if I can just jump in there about GST, because as I said, GST, and as we both know, GST can be a very complex area. But probably the number one thing people should think about with GST is you don't want to be in a position where you're either paying GST and it's a cost to you as opposed to being able to be passed on to the. Because if you're Joe Public out there buying a property, you don't care what the GST is on it. You just care what the price is. So it's one way or the other. Someone's got to bear that GST cost. So, but the other thing is GST credits. So it's just if there's one thing people want to keep in mind about is, well, two things you want to keep in mind is, you're going to have to pay GST on a particular transaction, and are there going to be costs that have GST embedded in them that you're not going to get a credit for because of the way the transaction works? I mean, if you understand those two things, then you go to a GST, someone who's an expert at GST, and you get into the ins and outs of it. But you at least need to know that's what the issue is. Am I going to have it's 10%, but 10% of a particular number can still be a significant amount.
1.5 property.
So you just got to know, is there going to be GST that I'm somehow one way or the other going to bear that cost, and do I need to factor that into my budget?
Right, correct. I think that's the most important part, which is, hey, do I factor this into my budget? Cool. Let's get into this, because the way I see it, and the way that you've put this, well, we're going to bring up the chart in a second, different buying entities. So at no point ever, listeners, have I seen a good enough table that breaks down pros and cons and the different elements of buying different structures. And I'll share this with you guys listening as well. So as we know, you can buy in your personal individual name. That's one. You could buy through a family trust. You could buy through an investment company, which is also known as an SPV, a special purpose vehicle. Yeah. And then you can buy through a self-managed super fund. Yeah. Let's go through each of them.
Sure.
And I want us to drill down. I'm not sure we can bring this graphic up as well. But what we're going to do is, if you're listening on audio, jump into YouTube and pick this up from this timestamp as well. But what you'll find is we're going to go through each of the different vehicles for how to purchase. And this is courtesy of the Australian Financial Review.
That's right. They produced I was quoted in the article, but they produced the table.
Correct.
So I won't take credit for that.
Don't give credit. We will give credit to the AFR
Absolutely.
producing this great help. So let's have a look at this. So if you're buying through your personal name, the income tax rate is based on your taxable income. Taxable income.
Correct.
Great. Capital gains tax. So say, for example, I have a property in my individual name.
Yes.
I then go to sell that property, and let's say I've bought it 5 years ago.
Yes.
So, past the 12 months.
Yeah, correct.
So I do get the 25% discount, for example. And so that's then based
50% discount.
Sorry, 50%. Sorry.
Yeah, as long as it's a capital transaction, which is the sort of point I was making earlier. Yeah.
Great. Thank you. Which is where we go into the CGT discount, which is just here. So 50% if it's owned for over a year. And then you get access to the money straight away. So you sell it, you get your money,
correct,
and that's where you get your capital back.
Yeah, absolutely.
Yeah, asset protection, which becomes very important. Either occupation for some people, or just in terms of how they're building out their portfolio as well.
Yeah, correct.
This becomes important, which there's no asset
No
protection when you buy an individual
correct.
name.
Yes.
Why is that important or unimportant for some people?
Well, it's depending, as you say, it depends on occupation but for professional, if you're sort of in any, it basically comes down to risk. It's risk management. I mean, asset protection is risk management. So if you're in any sort of a business or trade or profession that where you could be liable for the work you do or the work your business does, then you're carrying risk. So a partner in an accounting firm, like, I'm going to want to consider asset protection because there's risk there associated with the things I do, and probably the same for yourself.
Absolutely.
I'm sure.
Yeah.
So it's just a matter of where do you put your assets and how exposed are they to creditors.
Yeah.
At the end of the day, and that's not doing anything sneaky. That's just really being it's sensible, structuring really, which any business or anybody would do if they're looking at if they're looking at structuring their wealth.
Yeah, the side of me many moons ago would have gone, hang on, if you're not doing anything wrong, well, what have you got to hide, for example, by moving assets out of your personal name?
Yes.
But it's more just to say this is purely an asset protection play, not
that's right. And
I'm doing something dodgy and I need to kind of move things into
that's right. And it's not just hiding it; it's probably perfectly transparent, but to the extent of but it's also not it's not, and it's paying. You're also looking at the tax. It's obviously has tax impacts. So you're but you're putting it in the appropriate place. And
cool. Take us through intergenerational wealth transfer as a topic. What does that entail?
Well, that's obviously a very big topic again. But as is mentioned on the graphic here, if someone owns an asset or property individually, then that's there till their death. Unlike something like a trust, we'll talk about trusts, which can have limited lives. And so it's them until they die. One of the beauties about Australia is we don't have death taxes and gift duties like they do in, for example, the UK, the US. And so in a lot of those, in the US, you've got someone who's an estate tax expert, and they spend all their time just trying to work out how you deal with managing inheritance tax effectively. Well, the good thing about Australia is something will pass on death, will pass to someone's nominated beneficiary. Someone's nominated beneficiary. It could be it depends on their will. Could be their spouse. Could be their kids. Could be their best friend. Whatever. But they've got the ability to do estate planning, and so estate planning is a hugely important thing. But that all depends on their estate planning. So,
yeah, great.
The point I was sort of to finish off that point is that there is no direct sort of death taxes as such. So in fact, the thing about it's almost the opposite in a sense, our CGT regime, because an asset will pass through to their estate or to their beneficiaries, and there's our tax law says there is no CGT event, is what they call it. Talked about CGT events is what generally triggers a CGT liability. So death is not a CGT event. An asset passing under an estate to a beneficiary is not a CGT event. So effectively that keeps on going. So there's no tax payable. So that's a really important thing to be aware of.
Good one. Thanks very much. Lifespan, so you mentioned until death there as well. Complexity, it says it's less complex, fairly straightforward, for example.
That's right.
And then lower cost of just administering and managing this.
Absolutely.
Yeah. All right, cool. Thank you. Let's jump across to the next one. I'm going to get this right. Okay, what have we got here? Family trust. Perfect. So take me through. Let's go from top to bottom. Take us through what's involved in buying through a family trust.
Okay, so family trust, which is what people probably will commonly understand, is just what we call a discretionary trust. And I know when we were chatting before that there is such a thing as a unit trust. Are you happy to sort of to touch on that as well? Or
absolutely, I want to go through it all because
I think we should
people talk about
both.
Trusts and then they go, "Hang on, but what's a family? What's a discretionary? What's a unit?" And I'm like, let's put this on the table.
So let's get that in. I think we should get into that because that is and family. There is no such. I mean, in technical terms, there is no such thing as a family trust, or in like there's another technical meaning of family trust, which would trust me, you don't want to get into right now. That's a very technical area. But in the way we're talking about it here, a trust can be a discretionary trust, and that's what most people call a family trust, and that will mean that it's extremely flexible, which I think the point is made there somewhere. It is more complex, yes, but the flexibility is one of its big advantages. And so, thinking about it in tax terms, so you buy a property in a discretionary trust. Let's say you're buying it, you're renting, and you'll eventually sell, just to sort of maybe cover off both parts. So, if you're renting that property, then the the net income will be a certain amount, and let's say it's not negatively geared, so it's a positive gearing, positively geared investment. So the essentially the trustee of the trust can nominate every year. In fact, should nominate every year. The deed will say you should make a decision every year and document that decision as to what proportion of income, of trust income, should go to a particular beneficiary, which could be an individual, could be a company, could even be another trust, but there's a whole lot of flexibility around it, and therefore potential complexity. So that allows you to do a lot of planning, tax planning. You can, so somebody, a couple might, even just a couple, even if they're going to have kids, forget about kids, forget about any other entities at the moment. A couple owns through a family trust. They could own the personal, we talked about an individual, but a couple could own a property jointly. So therefore that's a 50-50. Well, they could actually own it legally. Technically they could own it in different proportions, but whatever proportion they own it in, that's fixed. So most commonly it's 50-50. So they own a property 50-50. Then if there's net income, they pay tax on half of that each. When there's a capital gain, they pay tax on half the gain each. So that's the way. It's as simple as that. Here with a family trust or discretionary trust, you can say, well, I'm going to give 60% of the income to this person and maybe 40% to someone else, or one of the spouses might have a high income, $300,000, so they don't want any trust income. So the trustee says, well, I'm going to give it all to the other spouse, 100%. But next year the situation may be different. So it gives you that flexibility, and you can even do capital gains separate to rent. So rent might be someone might want to give the rent to one beneficiary and the capital gain to a different beneficiary. And they refer to that as streaming. So you can stream with different components within a trust. So that's where you get that flexibility, and that can be important. I know there can be a lot of detail to this, but that can be important also think about it over a life cycle. When people get older, even when they get into retirement, they stop working, they don't have any income. They might be getting a tax-free pension from their super fund. So they don't have any income. They've got investments, which might include property sitting in a family trust. They now don't want to have distribute the income in the same proportions as they used to. They do want to do it in a different way, so they can do that. And when they sell the property, they can do that in a different way as well. So again, it gives you that flexibility. The only thing I'll throw in there, one thing often flows to another when you have a conversation like this. So I said the property is positively geared, but let's say it's negatively geared.
Yes.
That's probably something, obviously this table covers a lot of good stuff. It probably doesn't touch on absolutely everything. If you've got a loss, if you've got a property, you've got a family trust, the only thing it owns is a property, and it's a negatively geared, so it makes a loss. That loss is trapped in the trust. And there's some sort of fairly complex rules around how the trust can use that loss. But essentially, in simple terms, it makes a loss this year because there's gearing in it. Over a period of time, maybe that becomes positive as you pay the debt down, or maybe it's always negatively geared and eventually they sell it at a capital gain. And so the trust, you can't distribute those losses. So the individuals on $300,000 are paying their tax on their salary. They're not getting the benefit of that negative gearing.
Yes.
But down the track, eventually they'll claim the losses against the capital gain, but that could be years in the future. So you have to look at, do you want to actually negative gear? And if you do, maybe personal is the way to go. So it's horses for courses. There's no one single answer.
If you buy in your personal name, at some point you will reach a borrowing capacity ceiling, for example.
And
so there's like we say, unintended consequences.
Yeah, correct. Absolutely. So there's a whole lot of things.
Solve one problem, but you've created another one for
That's right. And I may say there's a great tax structure, and you might say, well, but how can we get someone to lend you the money? So there's all of that.
So if I just go back a step, and someone listening go, Peter, what's the difference between a family trust, a discretionary trust, and a unit trust?
Okay, good. No, good. So that's the next point, Aaron. You're right. So a unit trust is generally, in its simplest terms, it's similar to a company. You have it. It's meant to be a fixed. So you have units, and it's often used in property in various ways. And so you have units in a company, in a unit trust in the same way that you have shares in a company. So there might be 100 shares on issue in a company. Someone has 50, someone else has 50 shares. So in the same way, someone might have, you issue 100 units, someone has 50 units and someone else has 50 units. So they have 50% each, or obviously if the numbers were different, you'd have different percentages. So the percentages are fixed. So in terms of what I was mentioning earlier, the income would then, and capital gains, anything, whatever's coming through the trust, if people have units, that would flow. It would have to flow in that proportion. So it's fixed, as the name suggests. And it's the unit is essentially fixed. So and so that will then, you don't have that same flexibility. But there's other, as you say, there's unintended consequences. So there can be other reasons. There can be reasons why you want to have a unit trust. I don't know, one we talked about and people will be aware of is land tax. You pay. There's a land tax threshold that individuals and you're probably going to get onto that, but just but just to throw that in there now, the individuals can have a land tax threshold. This is a state by state thing, but every state, I believe, has a land tax threshold, and a unit trust will apply a land tax threshold, but a discretionary trust doesn't get the threshold. So that can mean, especially if you hold a property for a number of years, that can mean actually quite a bit of land tax, especially and values are going, especially in New South Wales. I've noticed in recent times that values have gone up a lot. So people's land tax bills are going through the roof. And so that's something you really got to think about.
Thank you very much. And then what's the difference between a corporate trustee and an individual trustee?
That's a very good question. So, okay, well, in a tax sense, I don't know, this is not just about tax, but I guess that's always the first thing I think of, because that's what I do.
Yeah.
But in a tax sense, so the trustee doesn't really affect the tax treatment as such. But so the way of trusts, and this is all, of course, based on Old English, all this sort of law comes from Old English law. Go back to the Crusades, whatever, when trusts were invented. And but basically, a trust has to, when you create a trust, there has to be a trustee. Because a trust itself is not a legal entity, has no legal status, but the trustee has the role to act on behalf of the trust, to enter into contracts, to transact just generally. So the trustee signs a tax return on behalf of a trust, all those sorts of things. And so it can be an individual, and it can be a company, as you mentioned. Most best practice would generally be to have a company, and that it doesn't really matter who owns the shares in the trustee company, but the directors of the trustee company are generally the ones that make the day-to-day decisions. And so if a couple will typically have a corporate trustee of which they're both the directors, and there's in the trustee, there's always what they generally call an appointer who has the power, essentially, although there's a lot of the underlying power in the trust, because they can change the trustee. So, but if one person, there's a few different situations, but if one person dies, for example, then, or they move overseas or different things like that, then there can be the trustee company continues in its role, and it might be just that person is no longer a director, but there's another director who is employed. Whereas if you have a sole individual who's the trustee, they pass away or they're incapacitated or something, then someone has to be able to step into their shoes. So if someone dies, it's generally their executor of their will. Okay. If they're incapacitated, someone would have to have a power of attorney, or you get into all sorts of legal issues there. And so, it's for a lot of reasons. It's but the other thing is the trustee is, in a legal sense, the trustee is liable for actions of the trust. Can be liable for actions of the trust, although they do on behalf of the trust. So generally they're indemnified by trust assets. So if a trustee does something and they're sued, they've got the access to the assets of the trust to I suppose they could sell the property, and then if they get into the difficulty, but it's depending on it, you are taking on a risk. Generally, it's like being a director of a company. You always take on a certain level of risk, and you're taking on a certain level of risk to being a trustee. So having a corporate trustee probably just as another layer of protection for the person involved, if that makes sense.
Cool. Yeah. Guys, if you're listening a little bit like me, just going, whoa, that is a lot of info. You're not alone. I do this fairly regularly on a day-to-day basis, but even then, like, to the uninitiated, this is probably where eyes glaze over. Absolutely. They're listening. They're going, mate,
what does that mean?
This is generally where you go with you have a good trusted relationship with your accountant.
Absolutely.
You go, all right, you know what you're doing. Yeah, it's like an architect, and they go, mate, this, and they got the plans. You're like, all right, great. I'm just going to entrust this to you because this is your zone of genius and this is exactly what you do for a day job. I'm not going to try and tell you how to do your job. So
Sure.
I think this is why it's important. I think what you've done there is, one, there's a strong level of technical knowledge. Two, it's going, hey, mate, this all happens on a case-by-case basis.
Correct.
So
Absolutely.
what suits one person may not suit your circumstance or the period in time that, or the stage in life that you're in as well.
Absolutely. Yeah.
But again, we're saying knowledge is power. Let's unpack all this, hopefully demystify it. But again, if we're just having these open conversations, if we can just kind of plant the seed for a lot of you guys listening to go, okay, here's when to pull that strategy off the shelf. And here's maybe not one that's applicable for you as well. So I want to keep moving.
Absolutely.
If we move through, so to the investment company.
Yeah. Okay. Well, I guess I sort of, as alluded to before, and as you've said on this great here, a trust. So a company can have a 25% or we currently have either it's either or 25% or a 30% rate. And the rules, as with a lot of things in tax, unfortunately, and I even say unfortunately because we'd sometimes like things to be a bit simpler too, but it's that the 25% rate was really introduced for small businesses. So it's usually meant to be business type entities. So if you're talking about a property vehicle, an investment vehicle, it's generally going to be a 30% tax rate, which is certainly better than 47%.
Yes.
So
yeah, spot on. Okay, great. Just come through here, no capital gains discount, which we spoke about before. For example, you can choose whether you pay dividends, so distribute out of
or retain if you don't, if you don't want to, if the individuals or beneficiaries have already got, or the shareholders in this case, that the shareholders have already got enough income, they don't want to take a dividend, they don't have to, as long as they don't take the cash out without paying a dividend. There's a whole lot of rules around that. People will hear the term Division 7A, and that sounds like a bit technical, but it's probably, in a way, it's one of those terms that you can throw it around because it's used so often, and it's such a fundamental thing that what it boils down to is don't just take the cash out of a company and not pay tax on it. It's really that's all Division 7A is about. So if you're going to take the cash out, there's a tax cost to that. But if you don't want to take the cash out and you don't want to pay the extra tax, then you have that ability.
Perfect. Thank you very much. How does it generate intergenerational wealth? Like, what does that entail?
Okay. So a company can, certainly a shareholder. So company, you can have different shareholders. Individual, you can have a shareholder can be a trust, as is mentioned in the slide there, or it can be individuals. But the thing about it is it doesn't, and it probably links into the next point about life unlimited lifespan. So companies don't. And we sort of skipped over the idea of a trust. A trust, depending on which state it is, can have a limited life cycle. New South Wales, 80 years. Queensland's 125. They call that the perpetuity period, and South Australia is actually unlimited. But that's, so sometimes, in fact, we do set up trusts that are meant to be, if you're talking about high wealth families that are intending to hold wealth for multi-generations, they will sometimes establish a trust in South Australia. And it's governed by South Australian law, but it means it, because the worst thing in 80, you sometimes see 40-year trust, but a trust that was, you will see sometimes now a New South Wales trust that's keen towards the end of its 80-year life. And again, we won't get bogged down in the detail of that, but it can have adverse tax consequences if you don't plan it properly, and the trust actually has to end, which means the assets has to go out of the trust to somebody, and there can be tax consequences of that. So go back to the company one. What that means is that companies don't have a life; they are unlimited lifespan. So that is where the intergenerational wealth transfer, you can pass the company, and we have many clients who have investment companies, whether they're property or shares or whatever, but they have entities, companies that have been passed from one generation to the next.
Wonderful.
So you've got that ability.
Great. And we speak a lot about intergenerational wealth through property. So again, this is something to think about. If it's, I want to pass the baton on, or if it's, hey, I want to get to retirement then exit, different strategy as well. And sometimes if you're younger, newer, or slightly inexperienced investor, you don't know what you don't know, and it's almost going, I don't know what I'm going to do with this property. I don't know if I'm going to have kids. It's like, all right, cool. Let's try and keep it as simple as possible, but build in some buffers or some ifs or scenarios.
Simple is, and that's a good point you raised there, Aaron. Simple is good. Like we see sometimes you pick up a client and they have their structure diagram is on a page, and there are so many trusts and so many companies in there, and you go, why do they even have these companies? And you ask the client, and they haven't got a clue.
No, the accountant just went to town.
And I don't like to criticize other advisors because you don't know, and I'm sure you don't either. I always give people the benefit of the doubt that things might have been done for a reason.
Correct.
But sometimes they get out of control over time, and then you lose sight of what. So I always think often simple is complex structures can have a purpose, and if so, yes. do them with the appropriate advice. But if you don't need a complex structure, don't have one.
I love it. Love it. Great. And the last one, which I think is probably been one of the buzzwords of the last probably 2 years. I mean, from an SMSF lending perspective at the moment,
sure.
Peter, a bank's normal turnaround times to pick up an application is 3 to 4 business days.
Right.
As we talk today, to pick up an SMSF loan for an assessment is 12 business days, 15 sometimes. That just tells me as a massive lead indicator. The pipeline is jammed full of people trying to buy through a self-managed super fund. Now, this again is not a one-size-fits-all model for everyone.
Definitely not.
Most financial planners generally get heart palpitations when they hear their clients with low balances trying to get into the property market.
Absolutely.
Some accountants go, "What are you doing? I'm not going to set up this SMSF for you," for example, as well. Like the whole statement of advice, that statement of advice ship has sailed, and it's very much if you want to go do it. And, it's there's a lot to think about, but we generally want, it's something to look at, scratch the itch. Let's go through a little bit.
Yeah, and look, it has its place. And as I said, as I say, I'm not a financial advisor, and even the financial advisors that work within our firm are similar to what you've described. They're very wary of property in an SMSF, and they're going to want to know really why do you want to do that? What's the is that a sufficiently diversified investment for you? And all that stuff. And I don't give that sort of advice, so that's not my area. But you're absolutely right about that. But where it has its place is commercial property, and obviously and again, I'm not an expert in superannuation, but it's you have to be there's a lot of very highly regulated, very careful what you need to do, and generally, I think it generally seems to work with commercial property, particularly. The classic would be someone who runs a business. They either buy or transfer their business premises into their SMSF, and that can work really well in the right situation. And so it's a matter of just how do you do that? Really is the key. And then, to look at your cable there, and so just to touch on that, I mean, so this is a fundamental aspect of super. As obviously the Australian super system is extremely tax effective and generous, and it's people can argue the politicals about whether it's too generous and to who and whatever, but regardless, it's the system we have, and some people should be putting a lot of planning into it. So accumulation phase, so as those of us who are still working, we're accumulating our we're not quite at retirement age yet, so we're building up our super. 15% is a lot better than that's better than 25, 30. It's a lot better than 47. So
15 is great. Zero
is even better. So this is where and that's the strategy. That's the retirement strategy, where you get the right advice on your retirement. So you build up to a point where you get to the retirement age. You generally at least got to be 60, but you hit that point where you do actually meet the conditions to be able to access your super. Subject to the relevant limits, and we don't need to go into all that sort of detail, but there's only so much you can build up in super now, particularly for those of us who are coming through. We can only get super to a certain level anyway, but whatever you've got there, pension phase is fantastic, as you say, Aaron, because you pay no tax on the super fund pays no tax on income. There's no tax on withdrawals because there's been tax on contributions generally, or along the way, one way or the other. And so it's at that point it becomes very flexible, because there's the restrictions on getting money out of super very much virtually disappear to a large extent, and you have to take a certain amount every year, and that is, and certainly if you're talking about property, I mean, one of the biggest problems with property and super is that you can't sell part of a property, so it's illiquid, and it doesn't so it depends on the circumstances. But if you've got it the right situation, being in a position where you're paying no tax is a pretty good place to have it, particularly if there's a huge capital growth. And then the capital gains again, so it's similar to the 50% discount for individuals, but it's a 1/3 discount, so effectively. So it's a 33% discount means that the 15% tax comes down, if owned for more than 1 year, comes down to 10% on capital gains, or if they're in pension phase, the capital gains is also zero. So that can be, again, a very good situation if you plan it well.
Love it, man. Thank you very much. I really appreciate that. Like I said, we'll include a copy of that table. I think, you nailed it before, which is the only things that are probably missing off here is your land tax implications and your gearing, positive, negative as well, which
So obviously they were only obviously trained. I assume they put this table together for a purpose, so they felt they couldn't cover everything.
Oh, completely. I mean, it just could keep going.
Yeah, absolutely.
Isn't it? Like all the different facets and elements.
And it doesn't touch on GST.
GST is another one. Very good.
But that's not so much as about structuring, because in a way GST is GST. But it's but in any case, that's it covers a fair bit.
Yeah, thanks. Yeah, I appreciate that. Mate, one of the other questions I've got for you, and this is probably something that's closer to my heart, I think, which is we've got, I've bandied the term around a fair bit, Henry's high earners, not rich yet. So that's where that acronym Henry's comes from. A lot of our listeners, I'd say, probably fit in that bracket. They're earning 200, 300, 400 upwards, for example, and they're going, mate, on paper I should feel rich.
Yes,
but bank account cash flow, I don't feel that wealthy.
Especially when you look at Sydney and Melbourne property prices.
Correct, right? And there's a slight lifestyle that happens with it, and I really want to flip that script to go, how do you get yourself from not rich yet to being asset rich, right? And cash flow rich. You obviously work with some high net worth people, and they've kind of crossed over. Success leaves clues. What are they doing particularly? What decisions have they made to get to that point that they've kind of flicked the switch and now they're going, they're rich?
Well, I think you sort of hit one of the points. Hit point there is they've made decisions. They've actually they've actually done. They've planned. They've got advice from. They've got financial advice. They've we talked about business owners before. You don't want to get to the end of your running a business and that's all you've got is your business, and then you want to try and you think I'll be able to sell my business, but there's a lot of other people trying to sell their businesses as well. So who's actually going to buy your business? Is someone in your industry going to buy your business, or are they just going to take your customers? And your staff and whatever. And so is it? Yeah. So that's obviously for business owners, even in employees. Again, executives, people can be on big salaries, but have they actually built up wealth? And that's about. And again, I'm not a financial advisor, but that's about getting the right advice, having a plan, having a savings plan. We talked before about our kids having. You try to instill in you. There's so many people. There must be so many books out there about how to and blogs and whatever podcasts are probably about how to teach your kids about money and how to save and get that. I think when I was still, old enough to sort of, we had the Westpac had the Daffy Duck sort of little savings books and things, and you could sort of, or CBA had the Dolomite, the money boxes and things, and so so all those things. There's obviously modern equivalents, but it's just about teaching kids how to save. Well, it's no different for adults. It's just getting into savings habits, which with the cost of living is a pretty hard. I mean, that's as you say, the listeners will say, well, that's great, but I'm trying to pay my bills and I got nothing left at the end of it. So that's not easy, but it's about where you can, working out how you can save, how you can develop saving habits, and then how do you go about that and go from just putting money aside to actually investing. And then it happens over a period of time, but and then tax effectiveness comes into it. But you've got to have something to save before you can invest. We can talk all about structures and how do you invest tax effectively, but you've got to have something to save first. So I think it's thinking about these things, getting the right advice from the right people, and just having a plan in place that for maybe short, medium, long term.
As you talk, visually what I see, it's almost like a jigsaw. Obviously, I'm 5 and 7-year-old daughters, mate. I'm doing jigsaws all the time. And I almost feel like that's, if I took your answer and put it as jigsaw puzzles, it's the right structure, it's the right team, it's having some cash left over to invest, it's having the right mindset as well, taking some action, buying the right properties or the right assets in the right structure, and you can kind of piece together this puzzle and go, right, there's no one piece without another complementary piece. For example, like to buy a property, you need to buy it in a particular structure. Now, what that structure is a different puzzle piece, but that's how the two kind of harmonize there as well. And as you say that, I'm like, if you're listening and you want a visual cue for that, how people then come together to have this complete, beautiful puzzle completed of, I am now unlocked my level of wealth that I wanted to achieve. It's a series of puzzle pieces that they've put together.
You've got to start somewhere. and I guess be a little bit lucky with the market too, perhaps.
Mate, luck is one thing, but what I say,
but that
luck
doesn't happen
is,
unless you start. Unless you don't get that lucky break unless you actually start.
well, you got to be in it to win it, right?
Correct.
So what's that? Preparation meets opportunity, and that's that intersection of luck. For example, people
sure.
He was lucky. He was like, yeah, but I mean, for me, I went
hard
years without taking a proper income out of this business to then get to a point that it's
right.
like, okay, there is a strong income to come off the back of any really good, well-run business like yourself. You go, you can't put the gas mask on others without putting it on yourself first. And I think even when it comes to talks about intergenerational wealth, the amount of times I see parents go, I want to help my kids. I was like, you know what? Help yourself, grow that pie as big as possible, and then there's more to help yourself in retirement and then to help your kids as well, rather than you're both on struggle street and no one's really getting ahead.
You don't want to start trying to get in, and that's probably the one thing people do in retirement is they try so hard to help their kids that they've also got to be able to afford to live in retirement as well.
Correct.
So it's a bit of a balance there.
Absolutely. Thanks very much, mate. I feel like we've covered a lot of turf here. And I know for a lot of the listeners, this is one of these topics that it'll stay up here, and to trying to get it to similar below the surface. I mean, where to buy a property is a far easier discussion, right? Sure. This is a hot spot, and we're buying down here at this price point, whereas this conversation really sits up here in the brain. But we're saying to all our listeners, hey, your day job, you do what you do, find someone that this is their day job.
Correct. Yeah.
Get in front of someone, that's property savvy, get in someone that's got years of experience, get in someone that's, done it for plenty of clients. And I think with their combination of experience and empathy, you're going to really kind of have this good relationship. Yeah, and absolutely. I think you and I are very similar in the sense that we're not here to take pot shots at any people in our industry, but there's in any industry, there's a bell curve of talent.
Oh, absolutely. Yeah. And there'll be someone who's better suited to you. You're better suited to them. You just got to find the right fit.
Yeah, I love it. So in terms of, I guess, your sweet spot, you said family businesses, families, SMEs.
That's right. So anywhere and family, high net wealth families are looking to grow their wealth, that sort of thing. Yeah, and I think we touched on and see. I think we sort of skimmed over a little bit, but there's one thing I know that we talked about off beforehand is capital gains tax concession. We talked a little bit about business owners, so there's a lot of CGT concessions around small business owners, and that sort of sweet spot and that's an area that I've advised in a lot, and property can be part of that. Might be just selling their business, but can also be selling their property, and sometimes there's a bit of restructuring. We don't want to get too much into restructuring now, but sometimes you got a structure and you say, okay, well, you get advice that says you probably could use a different structure. Well, how do I get there? What are the steps? What are the stepping stones to get there? And sometimes we've got some very generous rules around CGT concessions for small business owners or businesses or assets. Like they talk, it's the key term there is active asset. So a property can be an active asset if it's used in a business. So you can get those CGT concessions, which can basically virtually eliminate we get the 50% discount. But if you tick all the right boxes, you can eliminate the CGT completely on a restructure that changes the ownership of the business or the business, including the business property, or even on a final sale. And that sweet spot is a $6 million net asset value. So if people have essentially once, I mean, great if you grow your wealth to more than that, but if their business is worth a couple of million, their property is worth a couple of million or 3 million, you sort of put all those assets together and say, well, if you fit into that $6 million net asset test sort of threshold, and there's a whole lot of complexities behind that, but if people know that those rules exist, get some advice on it, and then they can potentially sell their business tax-free or with very little tax, they can also maybe sell their business property with very little tax. So, and a lot of that can be about, this is where, again, planning comes in, because structuring, if you've got to have the right structure and tick a few of the right boxes, and have probably taken some steps many years earlier to then later on reap the benefits under those CGT concessions. So that's an area that's it's obviously it's really relevant to business property owners, not to the more general property investors. But if you're in that category, it's something that people should think about.
Awesome. Thanks very much. Yeah, I think that's if you're self-employed and a small business owner, family business, and that's something that you're thinking about, which is, hey, the exit. How do I do that tax efficiently, for example? I know it's something that we've spoken about heavily in my neck of the woods. with no intentions to sell, but you got to think. Any business should be thinking. It's like any property.
What's your exit eventually?
What is the exit strategy, for example? That if the time was right, or something happened, touch wood's family, and you got to exit your business gracefully. It's like, hey, what's the best way to do it tax efficiently as well?
That's right.
We all know, mate. We all pay our fair share of taxes to live in this beautiful country.
Absolutely.
Tax is a success fee. We want to make sure our country is well run, but also on the same note, if there's ways to be efficient,
that's right,
with tax, then
there's a lot of tax concessions in the law, and they're there for a reason. They're
black and white.
There's a lot of sections in the tax legislation that are there for a reason, and so you should be looking to use them.
I love it. Peter, I want to say thank you very much. I appreciate it. I know you're a busy man, but mate, always great to talk from a tax perspective, because we've got to stay in our lane. I can talk all lending, and I'll see the world through my view. You'll see the world through a tax view, for example, and that's the lens and perspective that you have. Different perspective in planners, different perspective from a buyer's agent or insurance person as well. So that's why, again, we try to bring in people from all sorts of backgrounds and expertise. So guys, girls, I hope you've loved this episode. Share it with a friend if you think you've heard someone talk about tax structures or different ways to buy or purchase property. By all means, share this episode. And as always, if you want to be part of the Property Accelerator group, we meet on the second Wednesday of every month. We bring in special guests, or we pop the hood on a couple of scenarios and help you on your journey, because the journey together will get you further as well. That's a wrap for another episode of the Australian Property Investment Podcast. We'll talk to you soon. Thanks.